So if you come in with an open mind, and generally that opens for you opportunities because the buyer is looking to do the most out of those people that they acquired.
Everyone's doing these deals because they want them to succeed. Part of succeeding is growth. And when a company grows, it creates opportunities for the people within that company. So you have to look at it through that lens.
Welcome to this special MSP M&A focused episode of Sunny Silver Linings. Our guests today are both experts in MSP M&A. Joining Sunny today, we have Christian Fulmino, SVP and Head of Corporate Development, Dataprise, and Sam Levy, Partner, M&A Execution, Drakestar. Now, here's your host, the visionary founder and CEO of IT by Design, Mr. Sunny Kayla. Over to you, Sunny.
Sam and Christian, welcome to Sunny Silver Linings.
Thanks for having us, Sunny.
Thank you. Good morning.
Yeah, so glad to see you on my podcast. I know we have been talking about this very, very special session on M&A, and finally we are here. And this is my first recording for 2024. Okay, so we're going to start with overall understanding the landscape. What is the landscape today? What is the reality, M&A reality in the channel? And where do you see things going in 2024? And Sam, I would like to start with you.
Thank you. The reality is that it's a very active M&A landscape, and it has been. While at Drakestar, a tech-enabled services focused M&A firm, we saw a lot of sectors that were struggling. The MSP sector has been humming, and it's been a good spot to be in. That being said, there are maybe a couple of trends that we see and that are pushing the M&A in the channel. So the consolidation and the specialization of MSPs. Then things like the technologies that acquirers are trying to get, like AI, IoT, or going over some regulatory and compliance problematics, and as well as answering their customers' demands in terms of integrated solutions. So we see that demand from buyers, and that's keeping the channel quite active.
Yeah, so I would agree with Sam that the MSP industry from an M&A perspective is continuing to hum along. It's an active space. There's lots of PE-backed businesses like ours that are active in the space and looking for MSPs. Either to add functional capability or build out their geographic presence and open up new regional offices. I think we're seeing well-run, operationally mature MSPs still commanding a healthy multiple in the market. It's still very fragmented. There's lots of a lot of them do kind of hit a ceiling where the owner feels this is as big as I can successfully grow this on my own without taking outside capital, without expanding my management team beyond my kind of comfort level. That's one reason. Others are just getting to a natural succession plan time in their life, and they're saying, I've done this for 25 years, and I'm looking to take some chips off the table. And I think owners recognize that while the industry is active right now, it won't always be that way. There's always ebbs and flows, and there's certainly a want to make sure, hey, I get in while the getting is good, and we're seeing that in the marketplace.
Yeah, and I think the overall borrowing money or interest rate, the whole it changed a lot. So do you see any impact of the economy, interest rate, other things that are happening there in terms of the multiple, impact of a higher interest rate on multiples and other things that are happening in the channel just because of the interest rate?
The interest rate has a couple of impacts. So one, on the multiple side, again, I think the well-run businesses are still getting a good multiple. Is it off the high? probably slightly from the increase of interest rates. But I think the bigger impact has more been around deal structure. So where acquirers may have wanted to fund things with mostly cash at close when capital is pretty inexpensive. I think today, as we think about what are the multiples in the market, how much you can borrow, and what the cost of that capital is, things like seller notes, which when capital was inexpensive, if you mentioned a seller note, that meant you couldn't afford a deal, and you had to fund it that way. Today, I think sellers can look at a seller note as a really good way to diversify the cash that they're taking off the table, right? Because they're going to have some equity roll, they're going to have some cash that they take at close, and a seller note that's paying a very healthy interest rate is another income vehicle that really takes the total return that they're getting on their investment and is another piece of it.
Awesome. Thank you, Christian. And Sam, what do you see in that area?
Yeah, I would actually split the market into two parts. I would say the platforms and the add-ons. What we see for the add-ons, that's where the market has been humming and M&A has been continuing. For the platforms, the fact that interest rates came up and the price of capital, price of debt came up, meant that the returns for PE firms mainly were lower, and therefore they couldn't afford the sometimes frothy multiples they did pay for those platforms. Now the platforms that have been acquired now around 2-3 years ago. Some of them would have liked to go to market at this time, but that hasn't been the time to go to market for those platforms. So we've seen the humming and the bulk of the M&A volume from the add-ons, and much less from the platforms in the past year and a half.
Yeah, no, thank you for sharing that. There is so much interest in terms of knowing what's happening in the channel. There's, like, how do I build my business which is attractive for the buyers? So my question is, for MSP owners considering selling their businesses or preparing to sell, what key factors should they prioritize to make their company more attractive to potential buyers? Are there any common pitfalls that they need to be aware of today to make sure that they remove those dangers during the selling process?
So I would say that if we look at the about 3,500 MSPs in North America, and if we look at the size of those MSPs, you have a very rapid cliff after what you describe. If you fix the size of the MSP, I would say that the quality of the revenue, the customer diversification, the financial profile, and by this I mean like the growth and the margins, the operational efficiencies, management, some IP, and not to neglect client retention and satisfaction, which plays with the other aspects I mentioned. It's kind of everything, prioritize everything, but maybe some kind of order and what's feasible and what's doable, depending on the timeline of the owner and when they are thinking of selling.
That's so awesome. Thank you, Sam. Now, my the podcast is not completed without a talent question. What is your advice to people working in the channel? Means service delivery managers, sales managers, to all the different, like, the management talent that is working in MSP businesses. What is your advice for them to continue to do well in terms of right person, right seat for them? Sam?
Yeah, and by the way, that's really true. We sold last year the TNS group. It was a husband and wife founded company, and we sold it to Omega, another husband and wife founded company backed by a PE firm, Kingston. And just as an anecdotically, when the two teams met, that was a love fest, and there was a premium to that that was paid by the buyer by thinking they will reduce the risk of non-cultural fit, and that helps a lot. And from the seller's point of view, it wasn't the best offer we had on the table, but they felt more confident that was the right home for their MSP. Now, the main reason for failure will be one, cutting corner for poor due diligence, and the second will be the cultural fit. Now, if you work at MSPs or at any other organization that gets acquired, you need to come in with an open mind. And also, I see a lot of businesses where the employees or the manager are coming in. It's going to be hell. It's going to be. That's the fear of the unknown. So if you come in with an open mind, and generally that opens for you opportunities, because the buyer is looking to do the most out of those people that they acquired, and they're not trying to do bad. They want the acquisition to be successful. So there are opportunities. Look for them. Be receptive. Be adaptable, and be open.
Yeah, that's awesome. Yeah, Christian, you probably see this a lot as well when you are working in the channel, talking to people. Yeah, what is your advice for people to do well during companies merging?
Yeah, I think you hit on cultural fit, but it is important, and it's important because if you were to just do one deal, sure, you could spend the time and figure out, how do we take these two fairly different cultures and blend them together and find a way. But if you're a firm like us that's looking at 3, 4, 5 deals a year, having cultures that are aligned is really important, because you don't have the time to say, okay, it's just this once. I got to do it once. I got to figure it out. You really want to have a level playing field where, okay, going in, we both view employees and customers and training and advancement of the team in a similar light. For us, it's very important that our acquired businesses, are part of the overall Dataprise culture, but that they also maintain a local kind of regional office culture. That's a bit unique to them. And a good example is like client events, for example. Our client event in PEI, which is a business that we acquired in November, is a clay shooting event. That probably wouldn't go well in Washington, D.C., where we're headquartered. Our client event in our Dallas office is a crawfish broil. Again, great, but I don't think a crawfish broil is bringing people out at our Manhattan office, right? So there's certain local regional office culture that's really worked. This is why the business was attractive to you in the first place. Let's not destroy that. But at the same time, we do need people to come together under a broader corporate culture and feel like part of something larger. So that's important. I think for most people, getting acquired by a larger business, if you have your eyes open, is an opportunity. If you're at a business of 15 or 20 people, career advancement can only go as far as the person ahead of you. And unless that person, quits, retires, or whatever, there's not another opportunity to bring you into. If you then join a company of 400 or 600 or whatever the number is, you now have career opportunities that can go on multiple paths. You may be able to advance in the kind of position that you're in, but in a different office, right? If we need a level 3 person, well, let's look at all the level 2s that we have across all the offices and say who's ready to make that jump. There's always going to be an opportunity. So that eyes wide open, understanding that it to your point earlier, or Sam's point, everyone's doing these deals because they want them to succeed. Part of succeeding is growth. And when a company grows, it creates opportunities for the people within that company. So you have to look at it through that lens.
Yeah, no, those are very valuable insights for teams working in those businesses where there's some kind of movement happening. To Sam's point, there is, companies are trying to make their M&A transaction successful. That the vision that they have with that partnership is to create more value, that they're trying to make 1 and 1 3 by combining unique trademark strengths of different companies, creating their collaborations where the growth is more like 10x. And there's that saying that rising tide will raise all boats. And I think for people where they are driven, they are hungry for growth for their career, it's a big opportunity, right? So assuming good intent that no one is after them, it's more of creating that opportunity for everyone. And then understanding and also expectation that things will be different, right? It's not the same. The overall VTO or the vision of the new company is not the same. So they have to drive with a different approach and being open to change. What I think Sam mentioned, that be open-minded and assuming that good intent and finding opportunities, that it is an opportunity for growth mindset people, because that's what the company is doing. Company's growth mindset is they're ambitious. They will only be right alignment for individuals where their growth mindset, they have that ambition to grow 10x as well. And there will be a lot of room, as Christian, you mentioned, in terms of L2 positions, L3 positions, senior recruiter positions, senior HR manager, senior finance person. All functions will have more room in a bigger company to grow. When you are a small company, 10, 15, 20, then you are always limited with that growth in terms of your career pathing. And in a bigger pool, you have a lot more room to move around, also leverage more of your strengths to do teamwork, because there are a lot more positions where you can leverage your unique strengths to create value in your role. So there are a lot of positives. There's so much there, but it's not for everyone. And there is nothing wrong with saying, hey, I'm good with my career and this is how I want. Then I mean, it's just understanding that, also having that clarity, what you want as a person, as a team member, and is that aligned with the company's overall, the future company's vision, is very important. That clarity, what do you want? What company is looking for? Is there a alignment? So thank you so much for sharing that, Christian. And Sam, I truly appreciate your time. Thank you for joining me, and you have a great rest of the day.
Thanks, Sunny.
Thanks, Sunny. Thanks for having us. Take care.
Thank you for watching Sunny's Silver Linings. Don't forget to like, share, and subscribe. See you next time.